In March of 2020, the spread between U.S. Treasuries and investment-grade corporate bonds exploded. Of course, the story was that the economic hardship of the pandemic and the pandemic policies would call into question the corporate sector's ability to pay their debts. Although the move in 2020 was extreme in its own right, it was dwarfed by the move at the depths of the Great Recession. Now, 4 years later, and the landscape is much different for credit, as now the spreads narrowed to historically low levels. Is this suggesting that there's little risk in corporate bonds? Well, maybe. Now, in periods of high interest rates, the expectation would be for credit spreads to widen. The obvious theory is that if you're getting 5% on a risk-free treasury bond, why would you take the risk of owning a corporate bond if the return was only marginally more? But there may be another element involved. Perhaps the narrow spreads are indicative of an elevated amount of liquidity remaining in the system from increased deficits, or perhaps it's a reflection of a growing belief that demand for the ever-increasing supply of U.S. Treasuries is becoming a little less predictable. Previously, it was somewhat difficult to hedge the risk of a potential credit event, but that may have changed. On June 17th, the CME Group will launch Credit Futures, which is an intercommodity spread reflecting Treasury yield versus investment-grade and high-yield corporates, and it is based on the Bloomberg Corporate Bond Index. Now, this allows bond investors to hedge the credit component of corporates without a directional price bias. Historically, risk happens fast in credit markets and can catch even the most professional traders off sides.